Welcome to the Trade Savvy Academy. In this video, we'll explore 7 important factors to consider when making an options trade. These factors include number 1, market conditions, number 2, risk management strategies, number 3, volatility analysis, number 4, technical analysis, number 5, fundamental analysis, number 6, timing and expiry dates, number 7, profit targets and exit strategies. And always remember, appreciating every dollar in your trading account and avoiding trading options merely for the thrill of it is essential. When approached with discipline, options trading can be quite rewarding. Don't be a gambler. Starting with number 1, market conditions. Understanding the overall market conditions is crucial before placing an options trade. Traders should analyze whether the market is in a bullish, bearish, or sideways trend. For instance, buying call options may be favorable if the market is trending upward, as they allow traders to benefit from rising stock prices. Conversely, put options might be more appropriate in a bearish market since they provide the opportunity to profit from declining stock values. Number 2, risk management strategies. Understanding risk management in trading options. We will use a $25,000 account as an example in this video. Risk management is critical to trading options, especially when operating with a limited capital base, such as a $25,000 account. Effective risk management strategies help traders minimize losses and protect their capital while maximizing potential gains. The primary goal is to ensure that no single trade can significantly impact the overall account balance. However, should a stock make a big move in the direction of your option, it can surely have a much higher than 2% impact on the upside imbalance. I have turned $500 into a few $1,000s many times trading options. Key components of risk management. A. Position sizing. This involves determining how much capital to allocate to each trade based on the total account size and the specific risk associated with that trade. A common approach is the 2% rule, which suggests risking no more than 2% of your total account on any single trade. For a $25,000 account, this means risking up to $500 per trade. B. Stop-loss orders. Implementing stop-loss orders is essential for limiting potential losses. A stop-loss order automatically closes out an option position at a predetermined price level if the market moves against you. Setting an appropriate stop-loss requires careful consideration of market volatility and the specific characteristics of the traded options. C. Diversification. Diversifying your options trades across different underlying assets can help mitigate risk. By not putting all your capital into 1 or 2 trades, you reduce the likelihood that adverse movements in a single asset will have a devastating effect on your overall portfolio. D. Risk-reward ratio. Establishing a favorable risk-reward ratio before entering any trade is crucial. A common target might be a 1-to-2 ratio, meaning that you aim to make $2 for every dollar risked if the trade goes in your favor. This helps ensure that even if some trades result in losses, profitable trades can compensate for those losses. E. Monitoring market conditions. Monitoring broader market conditions and economic indicators can provide insights into potential risks associated with specific options trades. Understanding factors such as volatility, often measured by indices like VIX, interest rates, and earnings reports, can inform better decision-making. Trading options with a $25,000 account. When trading options with a $25,000 account, it's important to consider both strategy and execution. Selecting strategies. Depending on your risk tolerance and market outlook, various option strategies may be suitable. Covered calls. This strategy involves holding shares of an underlying asset while selling call options against those shares to generate income. I will cover these strategies in more depth in separate videos. Protective puts. Buying puts on an underlying asset you own can serve as insurance against declines in value. Vertical spreads. These involve buying and selling options at different strike prices, but with the same expiration date to limit risk while still allowing for profit potential. By implementing these risk management practices while trading options within a $25,000 account framework, Traders can navigate the complexities of the market more effectively while safeguarding their capital against significant losses. Number 3, timing and expiry dates. Options have expiration dates that significantly affect their pricing and potential profitability. Traders should consider how much time remains until expiration when placing a trade. Longer dated options generally have higher premiums due to the increased time value, while shorter dated options may experience rapid time decay as expiration approaches. It's essential to align your trading strategy with the expected time frame for price movements in the underlying asset. Number 4, volatility analysis. Volatility plays a critical role in options pricing and can influence when to enter a trade. High volatility typically leads to higher option premiums, which can be beneficial for sellers but detrimental for buyers if they purchase at inflated prices. Traders often look for opportunities during periods of low volatility when option prices are more reasonable, allowing them to buy undervalued contracts that could appreciate as volatility increases. Number 5, technical analysis. Utilizing technical analysis can help identify optimal entry points for options trades. Traders should look at charts and indicators such as moving averages, support and resistance levels, and momentum indicators to determine potential price movements in the underlying asset. A well-timed entry based on technical signals can enhance the chances of success in an options trade. Number 6, fundamental analysis. In addition to technical analysis, understanding the fundamentals of the underlying asset is vital. This includes analyzing earnings reports, news events, economic indicators, and other relevant information that could impact stock prices. For example, if a company is expected to report strong earnings or launch a new product that could increase its stock price, it may present an opportune moment to buy call options. Number 7, profit targets and exit strategies. Defining profit targets and exit strategies before entering a trade can guide decision-making throughout the trading process. Whether using trailing stops or partial profit booking methods discussed earlier, knowing when you plan to exit can help avoid emotional decision-making during volatile market conditions. In summary, traders should place an options trade when they thoroughly analyze market conditions, timing related to expiry dates, volatility levels, technical indicators, fundamental factors affecting the underlying asset's price movement, established risk management protocols, and defined exit strategies. If you enjoyed this video, make sure to give it a thumbs up and subscribe for more educational content about the stock market. Got any questions? Just drop them in the comments.